All right, everybody, welcome to the Life Money Balance podcast. Tax planning is always top of mind. So I got a special guest today. We got 5, so let's chop it up. All right, y'all. Appreciate y'all joining us today. We are live for the second time. These things are hard to do, but I love being live with y'all because all we got to do is chop it up. When things come to our mind, we just get to converse about it. And wow, I got a special guest with me today. We're going to be talking about tax strategies for high income learners, and no other person better to do it. The Twitter champion, Mr. Thomas Kopelman, co-founder of AllStreet Wealth, top 100 advisor by Investopedia, and my good friend. Thomas, good seeing you, my friend.
Good to see you, man. Thanks for having me. Couple things. One, sweet intro. I don't know who developed it. That's really cool. I'm jealous. I don't have anything that cool. And 2, I saw you got some award. I think you were like top 10, like people to watch in the industry or whatever.
Yeah. Oh, wow. Thanks, man.
That was awesome, dude. Congrats. It's like all people who are like owners of big tech firms or really large RIAs. And I mean, super impressive.
Well, man, I appreciate you. Well, here's the thing. I try to win an award or two so I can, tell my mother.
Yeah.
You always have one champion, right? It's your mom, your dad, and my sister. And if we don't do anything else, Thomas, we're all over social media and all that type of stuff. But if your wife loves it and your parents and your sister and your siblings, then you're good. Right.
For sure.
That's what's up, man. That's what's up, man. Well, this is a topic I know that's near and dear to both of us. We serve. I know your firm serves businesses and high income earners like mine. So yours is AllStreet Wealth, mine's Concurrent. And so you post all the time about this topic. Why is it so important? Why is it so important?
Yeah, I think for me, the reason why it's so important is because like I have every prospect that we meet with, they apply. And one of the questions is like, why are you reaching out to us now? Every single person says taxes, right? Mm-hmm. I think it's fair to say that CPAs are really well equipped to do tax planning. They know taxes really well, but there is a disconnect that's happening right now where most CPAs are not doing tax planning for their clients. And when I talk to CPAs about this, the biggest answer I hear is we just aren't able to sell it, right? Like people just want to come to us. They want to pay us $500 to $1,000 and they want to get their return done. And then they wonder why we don't do any planning, but they didn't want to pay us, right? And there are plenty of amazing CPAs out there who do tax planning, who are doing more of like the yearly fee model, but it's still a small segment of them. Still a large amount of CPAs are working with 1,000 clients, doing as many returns as they can do, and they don't really have time for it. So my thing was, okay, if I'm going to work with people in their 30s and 40s that are making $500,000 to a couple $1 million a year of income, their number one expense is taxes, right? Every single person in that list is paying 6 figures in taxes, all the way up to, $600,000, $700,000, $800,000. And so I think, okay, I can charge a really good fee because I can do really good tax planning and help them, save that amount of money or make decisions that compound that really save them a lot in taxes. And if you think about it, number one expense, people just want to reduce that. And when you pay that much, if you can reduce their effective tax rate by a few percent, that is a huge difference long-term of what their wealth looks like.
Right. I mean, and it's every year. It's every year and it never goes away. I always share all the time that the tax man and death are undefeated and they're not going anywhere. I mean, so it's time to prepare for those at all times. And what I find too is that clients or, professionals want individuals to start looking at their tax planning, not just year round, but particularly this last quarter, because waiting last minute, oh my goodness. First of all, you're not maximizing the opportunities that you have out there. And secondly, it becomes more stressful if you just wait that later in the first quarter and you have to file extensions and all that. That's why when we talk about our year-end strategies or year-end sessions that we have with our clients, this is it, the holiday season, don't you think?
Yeah, I think for us, and what we try to do is really good tax planning is done in Q2. It's post taxes from last year, understand what happened, do your tax planning for this year. And what Q4 is really good for is fine tuning based on what happened, right? Like, do we end up having extra room in your 401ks, HSAs, et cetera? Have you done your backdoor Roths? Like, have you set up your solo 401k if you're a business owner? And, have you done the employee side and then the employer side? Well, what's the profit? What did you end up paying in wages? What room is there? And so if you don't do anything until now, and now is when you start the planning, like, I've been sitting down, I have clients who started more recently, right? And so we're trying to figure out, how do we get the solo 401k set up in time? And how do we get all the IRAs into it? And it becomes like this really stressful thing, which you can avoid by being proactive and not waiting till the end of the year. And I think this also kind of goes back to the whole thing of, why I feel like it's our job to do tax planning, is because a lot of the times you don't even meet with your CPA till next calendar year, right? Like,
right, yeah.
All of your documents, they're not used to these like Q3 and Q2 meetings. And so they don't even know where you're at. So like one of the biggest tax planning moves we make for our business owners is around QBI, which QBI is either 20% of business profits, you start to phase out, and then it becomes 50% of W-2 wages. And so like what happens is, you met with your CPA last year, your business did a couple $100,000 in profit. And then this year you're going to do $1 million. And so you don't want it to be based on this profit, right? You need to raise the salary up a ton. And you can do that at the end of the year through running payrolls to get this really large deduction, which allows you to put more into your solo 401k on the employer side. But if you're not meeting in that calendar year, you run out of those opportunities because you're not running a payroll in April for last year. Like, that's just not how it works.
Most definitely. I agree with you 100% that Q2 and Q4 are the quarters. I mean, because you don't want to wait till last minute. But, we could go on and on about, what strategies are most effective and this, that, and the other. I mean, the list is long. I mean, because I like your content about tax planning strategies. You mentioned QBI, and then there's just a whole list, right? So today we got time for like 5. So,
Okay.
Yeah. So let's get to these 5. All right. So I think number one is, our retirement plans. Retirement plans. These are it right here. I mean, we have small businesses that can maximize. They have all the space in order to contribute a lot of money. They could utilize so many aspects. We have employer-based retirement plans that every year, right, our contributions go up every year. And then also too, the catch-ups. I always ask my clients, I serve Gen X, I was like, look, do you like ketchup? And if you don't, you best get you some, right? Because some of the Gen Xers are behind, even the high income earners. So what's remarkable, right, about utilizing these our employer tax deferred strategies in order to contribution? Why should we maximize them?
Yeah, I mean, I think if we're talking through the lens here of people in their highest income earning years, I think it really is about deferring taxes, right? I think there's like the whole world out there that Roth is the greatest thing of all time and everybody should prioritize Roth. But I just can't sit down with somebody who's 40 years old, going to make $1 million and lives in California and tell them to pay that 50% tax when they could be deferring that to a future period of time. Because, right, when you take this money out in retirement, it's going to be at an effective rate. You're going to have some at 0, some at 10, some at 12, some at 22, some at 24. It is really hard to hit an effective rate of that 50, close to 50% that you would where you're at. So I think 1 is about deferring taxes. 2, it's about forced savings and investing for the future. I think, people talk about they hate lockup periods of 59 and a half, but in theory, it actually forces good behavior to not just be taking money out of your investments at really young ages. And I think something that isn't actually talked about enough, and I'm going to go to the business owner side a little bit, is it's super common for the business owners to just say, like, I'm going to be an S Corp. I'm going to pay myself the lowest possible salary. I'm going to save myself on self-employment taxes. And, we won't go on the QBI side of why that can be wrong. But the side of the, like, you have a solo 401k or whatnot, is if you only pay yourself $50,000, that employer side, you only get to do 25% of those wages.
That's
so
right.
That's 12,500 versus you basically have 42,500 or, it's like 43,500 of room left for this calendar year, where the highest wages or higher wages can help you with that. So I think a lot of this tax planning stuff is people hear one thing, and one thing is S Corp self-employment taxes, right? And what they're missing out on is added retirement contributions, QBI changes, like there's a bunch of other parts. And this is where I think the danger of learning tax planning from some social media influencer, I mean, it's super dangerous, is because they only know this basic part. And so they're making decisions on this information on one variable. And there was this TikTok actually that blew up this last week. It was like huge. Everybody's like, I had clients like, look at these sheets. They're beautiful. I looked through it and I made the sheets for our clients because they did look really good. But he basically showed the analysis between an S Corp and between staying as just, regular LLC. And it was like $50,000 of tax savings. But the only thing they looked at was self-employment taxes. When in reality, the number was like 3,000 because of, all of the differences that they left out.
Yeah, most definitely. And by the way, I think they're good social media influencers or finfluencers, right? And so we're a couple of them. So you want good information. So to your point, right? When we're talking about tax planning, we hear like the over Rothification of things, right? And we do, particularly we are talking about high income earners. They have specific needs for now. I mean, they need tax breaks now. I mean, so deferring taxes all the way to the end and just over worrying about the tax in the future. When, to your point, we're trying to mitigate and smooth the tax efficiency over time, not necessarily just have it all at the end. And there's so much things to consider, like you mentioned. And so I like to highlight with my clients, there is, yes, you may hear about, Roths and Roths are good. We're going to talk about that today too, and how to best use them. But what about your taxes now? And I think that's a very much overlooked aspect of tax management.
Yeah, I think it's really important to not be head down in one way, right? I think we hear from a lot of people like diversification on taxes is the right move, and I do agree, but I don't think you have to diversify every year, right? You get diversification by taking advantage of the right ones at the right periods of time. And Roth to me makes a ton of sense for backdoor Roths, right? That money was already taxed. You already use pre-tax options. Will either go taxable. Yes, there's flexibility, but if you live in California and that high of a tax rate with net investment tax, state, 20% capital gains, you're still at a 35, 36%, capital gains rate. So I think Roth is beneficial for there. I just think traditional also gives you flexibility that people don't talk about, right? They're just like large RMDs in the future. But a lot of these high income earners that we work with now are going to end up being retired at 50. They're going to be optional at 50. They might move from 2 incomes to 1. Now you have this room to do Roth conversions at lower tax rates multiple different times. I have clients taking a 1-year sabbatical right now, trying to decide what they want to do. And they're able to move $280,000 and fill up the 24% tax bracket versus what they would have been at before. So that's
absolutely. And you know what? I always share with people, you mentioned something about the 59.5 lockup. I share with folks all the time that the R and most of it's for retirement. So you do have other options in order to have more flexibility, like a brokerage account too. I mean, so it's really not a lockup. Like you said, it's more behavioral, and also it buckets a lot of things. Like, okay, put this bucket over here. It's for retirement. We're going to use that for later. We can go on and on. Okay, I want to get to a couple more points. Let's try going to donor advised funds. I mean, we got to talk about this. So let's just chop it up. All right. So donor advised funds, folks get to, have align their money with their values, right? Their charitable giving, but also take advantage of upfront tax deductions on what they contribute. So let's chop it up about that. I mean, what have your clients seen? My clients are loving them. What about your high income clients? How do they see it as benefit?
Yeah, I think I actually just met with a new prospect yesterday who basically he's been an executive at a publicly traded company. He's getting paid out through the rest of this year. And then next year he's done working. And he's like, hey, I don't know if I'm entirely done forever. If, I'll start a business in the next little bit, if I'll do something more fun. But, I made $1 million this year, probably never going to happen again because I don't want to work like I have been. And so we're thinking, one of the conversation points was, well, hey, you guys are charitably inclined. Why don't we, while we're in this income year, do the next 5 years of contributions, right? Because he has a lot of individual stocks, some of it from that employer, huge amount of gains. And so he has the opportunity to say, well, why don't I donate enough for the next 5 years? I can avoid those capital gains, get the 30% deduction against AGI. That becomes super impactful. But I also think taking, to another step back from this is people should almost always be donating stock or donating ETFs, right? Because if you're going to donate $20,000 this year anyways, and you have Apple that you bought for $1,000 that's worth 20, you can donate that Apple. You basically avoid that $19,000 capital gain. You also get a deduction against your income. And then you take the $20,000 you were going to donate and you rebuy back Apple with a $20,000 cost basis now. So to me, I don't really see any reason why you wouldn't take that strategy, because all you're doing is saying, I'm going to donate just like I would. I'm just going to do it in a more efficient way.
Absolutely. And the tax code, as we both know, is that the tax code treats cash donations and stock contributions totally different, and you get more bang for your buck if you go ahead and appreciate or donate that appreciated stock. And you just explained it well, and then you're not losing the stock either. You can get it right back. I mean,
Yeah.
so it's triple advantaged, right? So you're aligning your values, you're reducing your gain on your appreciated stock, and you get to buy back the stock and let it grow and compound back over time. I mean,
Yeah.
what are we talking about? Oh my
I think
goodness.
people really miss, like, when most people explain it, they just say donate stock, but they miss the part of, like, if you still want that stock, just buy it and raise your cost basis. So in the future, you're going to have significantly less tax as well. People just leave out that whole second side. So then people just write this off because they don't want to get rid of their Apple. When in reality, you're going to have the same amount of Apple. You're just going to have less taxes in the future on that Apple.
Absolutely. And then also being able to control where your charitable money goes. You don't have to dole it out all at once. I mean, there's a significant sum of money in donor advised funds that are just haven't been doled out yet. But it's pretty cool to have that option to where maybe in your faith house, or maybe somebody knocks on your door, or maybe it's somebody charitable giving function, and they're like, "Oh, okay, yes, we want your money," and you're like, "Oh, I have a donor advised fund." Well,
I don't have to think about coming on my checking account.
yeah, right. Absolutely. All right, let's go to number 3, which is, I know, one of your favorites. So let's chop it up about IRA, Roth IRA. Kind of out of order right here, but let's go with Roth IRA conversions and laddering them out. Okay. So, and not necessarily do them all the time, because what people forget all the time is that when you do your conversions, you have to have that side pocket of money in order to pay that large tax bill, and that hurts, because you got to bring that tax money out of your pocket. So laddering the Roth conversions over time, what's the advantages over those?
Yeah, I think it's, again, what we were talking about before, of really just lowering your lifetime effective tax rate, right? So if you've been deferring taxes at this really high rate, you're now looking for opportunities of, when can I convert these at lower tax rates? So really good times to do that are sabbaticals, lower income years, moving to one income, early retirement, and then also when the market's down. I think that's something that people forget is, if the market's down 30% and you can move it over, that gives you more room than you otherwise would have. And so, like, perfect example, I have a client that I'm working with. They've had a couple exits. They finished getting paid out this year from those exits. Next year, they're starting a new business that is going to be not super expensive. It'll be 6 figures to run. There's no way they're going to pay themselves next year because they're building a software, right? And so, wow, well, this is a really good opportunity to do the conversion. I think one thing to think about is, if you don't have very much in, traditional money, it's less advantageous. I think it becomes really advantageous for, this couple is estimated to have like close to $20 million in pre-tax accounts by the time they have to start to withdraw at 75. That causes a whole lot of tax issues. That means so much of their income is going to be taxed at the highest brackets. And so in their 40s, if we can move this money over and then it compound tax free, really, really impactful. And so we're looking at, okay, next year we can go all the way through the 24% tax bracket.
Yeah.
And that gives you an effective rate. They're in a 0% state tax. So they're probably at like 16 to 18% effective tax rate, when if they would have done Roth the last few years, it would have all came out at marginal 37% bracket. So that's a huge difference. And then now it compounds tax free versus not. And so I think this is where it becomes really impactful. But then you look into 2025, maybe the business is doing better. Maybe they pay themselves a small salary, $100,000 combined. Well, now we still have another $180,000 to do. And so now we've almost, we've cut down a good chunk, 33% of their pre-tax balances at a really early age, paying at the lowest brackets they're really going to have until, next time they retire or they fully retire, or whatever they end up deciding. But you never know, right? Like, I think a big question to ask people is like, when do you think you're going to want to stop working? And if people say 75, or 80, they don't really want to, you're not going to have very many good opportunities for Roth conversions where you might want to convert through higher brackets now.
Yeah.
And if
Yeah.
somebody's like, I'm going for fire, I'm going to be done at 40 or 50. Well, then you're like, well, let's defer everything we can in these high rates because we're going to have tons of time to convert it.
Right, right. There's a lot to noodle on right there. Like for instance, when folks are talking about Roth conversions, it's the timing. That's why laddering is so effective. Because effective, I guess that's a pun. Effective tax rate, because you can affect that effective tax rate, and also too, you have more control of when you want to apply the strategy, and you don't have to come off that big tax conversion bill out of your pocket, and you can, instead of bunching it all at one, you can spread it out a little bit more. So a lot of things that are lost in translation as far as this conversation is concerned is, yeah, Roths are cool because, later on the distributions come out tax free, but how do you do them and why? Why are you doing them? So I think that's huge. And then
Yeah.
also too, I think it helps mitigate the conversation of, to your point, you don't know what taxes are going to do in the future. I mean, all these conversations, I know some of my clients, they get on the tax kick that, tax rates are going to increase like 40%. I'm using some, large amount. Well, we simply don't know. And this is why using these strategies on an annual basis, yes, thinking long term, but use them on an annual basis has a little bit more effectiveness and compounding at the end.
Yeah. And in the years that it makes sense, like some years next year might be a high income year and you might not then, and you might not for 3 years. And then, the year after that might be a great opportunity. It really is a look at what's happening this year and is it the right decision? But I think the other thing that I love that you hit on is like the prediction everybody has about taxes going up. They're like, deficit is high. So the only rational thing is taxes are going to go up on the middle class. Right. And it's like, you don't know that. Right. And so I hear advisors say this all the time and they're like, we have everybody do all Roth no matter what, because taxes could go up in the future. And so I'm like, okay, wait, so we're choosing to pay the highest tax for certainty, right? That's what you want. They're like, yeah,
right.
I was
right.
like, do all of your clients own annuities? And they're like, no, that's entirely different. I'm like, if all you care about is certainty, then every dollar should be in an annuity. So we know the exact amounts we're gonna have in retirement. And then everything should be Roth. And they're like, but they're different things. I'm like, we don't know how the stock market's going to go and we don't know how taxes are going to go. So I don't know how you pick and choose guesses of which type of certainty that you want to lock in.
Yeah, absolutely. Absolutely. Well, we got a couple of more. So let's go on. So business owners, right? They can hire their children, but we're business owners, or even young people. I hire my niece. I mean, so I love the fact that she's 16 and getting a head on life and has an income that that my business can deduct, but also having and a Roth IRA. We're talking about Roth IRA, starting them early and compounding. My clients, they love this thing. I mean, so what about yours? What are you hearing, and what are some of the benefits that you see?
Yeah, I think the benefit one is, well, it's a deduction to your business because you're paying somebody else out. Two is then they have earned income and they can contribute to a Roth IRA, whether you do that for them or they do it for themselves, right? The third benefit that not talked about enough is the life experience that you can give them, because I think, social media plays this out to be like here's the standard deduction, pay them the standard deduction for, your 6-month-old to be modeling for your chiropractic business or something. And you're like, okay, I don't know how your kid's earning $14,000 at, that's the fine line I don't want to cross, but your example is really good of, 12, 15, 16, 17 years old. Like maybe they're going to help do some social media, or maybe like you have an office and they can help like clean, or they can kind of be like, the front desk person and say hi and grab people drinks. Like, I think there's a lot of things that they can learn. And again, right, like if you can do from 12 to 18 Roth IRA contributions for kids, like you're setting them up in a really incredible spot. So it is something I love, but it is something that raises red flags of like, one, like your baby is not modeling for 400 hours this year. Like, just be real here. That's not happening. That's a huge red flag. Like, just start them a 529. Like, it's not worth taking the risk. Also, paying them the exact as the standard deduction, probably also another red flag too. The odds that somehow they made exactly, 13,850 in the year is kind of like, I don't know about that.
Right.
But overall,
we know the IRS now, well-funded now. They're doing more audits and everything like that.
Exactly. So I think this is an amazing strategy that people should take advantage of when it makes sense. But the thing that bothers me is we're talking high income earners, we're talking people who do well. You don't need to cheat the system, right?
No.
There's so many advantages, use them properly. Don't cheat them because the risk isn't worth the reward or the anxiety that you have knowing that you crossed that line.
Absolutely, man. You said it perfectly. I share with people all the time, like the tax code. First of all, if you want to go to sleep, read your best faith book. That'll put you to sleep. But you still have faith, but it will put you to sleep. So it gets you to sleep. And the tax code, it's boring as all get out. But that said, the tax code is made for taking advantage of. It's full of nudges. It's full of suggestions, and it's full of rules that say, we're trying to help you. I mean, obviously, they're trying to raise, get some revenue in, but the rules are, like you said, 59 and a half. That's for, hey, we don't want you to double. I mean, we'll dip into your retirement. And even here, when you're talking about your children, life experience, right? You get to deduct the salary, and you get to put it into a Roth. It gets to, you get to have it grow tax free and come out or tax deferred and tax free. I mean, so all these suggestions about how can we align the tax code with the values and that we're living, and there's so many that you can align. You don't have to cheat, like you said.
And especially now with the rule of 529 to Roth, like the conversions allowed after 15 years, kind of like when they're really young and this is not a good strategy, you can just contribute to there and they'll be able to get 6 years of Roth done when they graduate college from 22 to 28, where they don't have to save for that. And you can just do it from the 529.
Yep, absolutely. So many avenues we can go down. Well, let's wrap up the show with last one. This one's underutilized, I think. So what's your opportunity zones in particular, underutilized because sometimes maybe advisors don't know enough about it, or even if they do, not exercise. I mean, but wow, when you can sell out of one strategy and invest in an opportunity zone and get deferral of capital gains and oh my goodness, this is what we're talking about: long-term tax planning and getting out there in those 3, 5, and 10-year windows. Have you used these before? I mean, I've used them for a couple of my clients, and they seem to like them.
So let me talk about the good and the bad. So the good of them is, right, like I have ours, let's say I sold my business, I have this large capital gain. Great. I can put that money into a qualified opportunity zone. It gets deferred to 2026. And then if I leave it in for 10 years, the growth on the opportunity zone is tax-free. Amazing. Downside about these are typically qualified opportunity zones have lower expected returns on the investment than if you typically some other investment. So it's sometimes hard to find good ones to invest in that, meet what you want, right? It's really great to defer taxes, but if for 10 years you have $1 million in investment that gets 1% rate of return or 3% rate of return relative to, some other investment, doesn't work well. The other thing that I struggle with on them is that, like, as fiduciaries, if we have an investment that fits our clients, we can't just propose it to one client, right? If we find a great qualified opportunity zone, all of our clients have to be made aware of that one investment. And so depending on firm size, and, I partner with this ultra high net worth firm, their client base is, almost $5 billion. Very few opportunity zones would they be big enough where their firm wouldn't have a risk of, like, we are the entire fund. But overall, I think amazing strategy. It's all about finding the right operators where you can see the track records of how they've done. I do know a few, and I think the benefits are really great. And hopefully the tax laws around this change where deferral isn't 2026, it gets pushed out, and maybe they make it like it's a 5-year deferral or, whatever, because pretty soon here in 2024, 2025, the deferral is so short that investment has to be super good.
Yeah, I like using the opportunities. Oh, you make great points right there. I mean, because you have to have the right clients in order to want to take care of these opportunities.
It is a 10-year lockup, right? So you need no liquidity from that.
Right. That's what I was about to say. The lockup, but the 10 years, but also there's windows of 3 and 5 years too. I mean,
where
so
you get still some,
right
amount of tax. Yeah.
Right. So you don't necessarily have to have that 10. I mean, I used to do alternative investments, and illiquidity premium was what was it, and the risk was it. And here in the opportunity zones, that's why I said 3, 5, 10-year windows, because you do have different tax exits in the code right there. I mean, so it's also value based for the client too. It's like if they do have those order of operation type of things already taken care of, maxing out your retirements and going down the stuff that we talked about today. And then somebody says, okay, well, I have a value system of reinvesting in some areas, and then you have urban development that's going on. So you necessarily don't have low rates. You could potentially have higher rates. Again, it takes study in order to do that. But so I think it's a value add, and also to what is that additional idea beyond after having your order of operations taken care of.
Yeah. And I think there's really important planning here around that year and the taxes owed and making sure, because if you're going to leave that invest for 10 years, that's not probably going to be the payout for the taxes. So people who, put $1 million in deferred capital gain, and you might have $300,000 of taxes, you got to make sure you do have the liquidity from somewhere else. Right. And I guess the other point just to make about it is I really do think that they are amazing strategies when you can find the right one, and the higher net worth you are, actually the better. Because if you sell a business and you have $20 million, right, it's pretty easy to carve out 2 or 3, right? And that can still save you and defer $1 million of taxes. That can be really impactful. I think it's harder when you're like, I just sold a business for $700,000. I've barely been saving, investing for a long time. Like, deferring taxes sounds great, but in reality, like, I do need a way to like catch up of my retirement goals. So I think it is all about like the right strategy for the right person with the right planning. And when you check those boxes, it's a pretty hard strategy to beat.
Yep. And we'll just wrap up with this because we can go on tax planning all day. I would say I agree wholeheartedly with what you just said, which is some ideas. I think the top 4, or not the top 4, but the 4 that we discussed before this 5th one, there's so many other check boxes that you can do, even as a high income earner, to mitigate your taxes, but also maximize your return, live life now, maximize your retirement later, all these things, and not get so creative sometimes, with ideas, because there's a long list before you get to those. Oh, what's your additional idea? Because something you mentioned, influencers. I mean, there's good ones and bad ones, but yeah, what about those? Just because you hear it on social media or from your friends or in the news or whatever, it may not apply. And so that's my point here. Just it may not apply. So do other check boxes before you get to some creative ideas. I wanted to throw one in there, this 5th one, because we need some ideas sometimes. Our clients ask for them. So with all that, Thomas, where do people find you? I know where to find you, but where do people find you, my man?
I would say Twitter is probably the best place. That's where all my best content goes. So I'm just at T Kopelman on Twitter. And then other best places, my podcast, it's called The Long Game. You were just on there a few weeks ago, and that's where a lot of it is. And then I also started YouTube about a month ago that I've been really enjoying, and that's also at T Kopelman. So any of those places, great places to learn from me.
All right. That's what's up. All right, everyone. Thanks for coming on the show, Thomas. I appreciate your time. Oh my goodness. So we're going to have you back. All right, listeners, I appreciate you tuning in to the Life Money Balance podcast. We chop it up about all things life and money. We want your life to lead your money, not your money lead your life. So continue to tap in, like, and subscribe, and we'll see you next time. Cheers.